This is Chapter 16, Video 2. Let's launch. All right, so in this video, we're going to talk about learn about corporate tax deductions, learn more about the DRD. We kind of talked a little bit about it in the previous video, but we're going to learn that there. No, I will not be talking about stock options. So if you downloaded the PowerPoints from the main book and they talk about it, I don't talk about stock options for a couple reasons. First of all, we didn't do the compensations chapter, and so my personal opinion is, and again, remember, I'm a compensation guy. So my opinion is, in order to fully understand how stock options are subtracted from the corporate world, you got to understand them on how they're received as compensation. And so if you don't get that, you're not going to get the other part of it. And I felt it was just a little too much to be doing with this. So I went ahead and I 86 that. All right. So limitation on net interest expense. This is a new one that came out as of the, Tax Cuts and Jobs Act. So the corporate net income expense deductions are limited to 30% of taxable income before interest, income, and deductions, also called adjusted taxable income, called ATI. Deductions are disallowed that are disallowed or carried forward indefinitely, and the limitation does not apply to taxpayers with annual gross receipts of less than $26 million. What does this mean? So you're working at a firm, you start working on a corporate tax return. If their average gross receipts are less than 26 million for the prior 3 years, you don't worry about this. There's a little box that you check in the software, say, this company doesn't apply to this. Boom, it's done. You don't have to worry about it. You kind of move on and life is good. If you're working on a company that does have to do this, though, to be honest, most of it, you're not going to have to calculate that much. The biggest problem that you're going to have when you're filling this out is making sure that the tax software knows what the interest deduction is and making sure that's recorded correctly. And that gets back to your tax work papers. And again, when we have our class meeting, I'm going to talk to you guys about book to tax differences. I'm going to show you some of that stuff, and hopefully that ends up working out well for you. Okay. You don't need to worry too much about that. I would say this is probably the easiest thing to do, because if you report it in the right line, it's going to do this for you. It's stupid easy. Let your software do the work for you. Why would you do extra work that you don't have to do otherwise? And if you do it correctly, you won't have anything to worry about. Net capital losses, no current deduction for net capital losses if it's an overall loss. And then what ends up happening is you can go back 3, forward 5, use carryover amounts on a FIFO basis. So you definitely want to go, when you're going back 3, you want to use it against the first year's 3, first of those 3 years first, because they're going to expire the most. And that actually kind of makes some sense. There could be some unfavorable temporary book to tax differences for the net capital losses. There could be some favorable ones in the year of carryback or carryover when it's used. And so that could just be something that you might have to deal with, that, if you're realizing that your book income and your taxable income are not matching what's on your stuff, you might kind of, well, what's causing that? You might want to take a look at that if you had any carry forwards that you had to deal with. NOL deductions. So in the past, if you had an NOL and you carried forward to the following year, you got to deduct 100% of it in that next year if you had enough income to use the NOL. If you didn't, it would carry forward to the following year. Now, under the corporate rules, there would be a time limit with that. That's not the case anymore. They changed it to make it indefinite, no carry back. However, they only allowed you to do 80%. I will tell you now, this actually just got changed, and I don't think the slides have been updated for this. So what happens is the 80% is no longer applicable. For this year, they're actually allowing 100%, and that is something that needs to be taken into account. Okay, so when you're doing the 80% of taxable income before NOL, that's not the case anymore. That's not the case as a result of the CARES Act. And here's the funny thing is that they're getting ready to launch a new. I'm shooting this in July. They haven't passed the stimulus package that they're going to do because of the expiration of the unemployment benefits yet. I don't know what's going to be in that bill at this time of the shooting. So this may change a little bit even more. So NOLs from pre-2018 levels can be carried back 2 years and forward 20. That is still true. So if you have some NOLs from back in 17 that you're still carrying forward, You need to make sure that you're following these rules. Now, here's the cool thing. The software is going to do that for you. You're not going to have to worry too much about it. Obviously, you want to make sure that the software is doing what it's supposed to do. I've caught several times that the software doesn't do what I want it to do, and I have to do a manual override and then do a paper file, and that's how we do this. So to compute NOL for the year, no deduction for NOL carrybacks forwards from other years, and also capital loss carrybacks. Carryovers are allowed to be used as the NOL computation, but not carrybacks. So here's an LOL example. Has net operating loss $200,000 for the year. Reported taxable income in 2021 at $200,000. How much can they offset? And this slide is going to be wrong because it's going to tell you can only do 80%. As of the CARES Act, all of it, $200,000, done. All right. Amount of the deduction, capital gain property. It's generally fair market value for contributions. And then, of course, if you do contributions of ordinary income, it's going to generally be the adjusted basis. So what does this mean? So if I'm a corporation and say I have some investments in some stock, and I decide that I'm going to take that stock and I'm going to donate it to a charitable organization. You have companies who actually do this all the time. What they're going to do is they're going to say, what's the fair market value of the stock on the date of transfer? And actually the forms that the IRS requires you to fill out, this actually is well, it's well done. I mean, you don't have to, you just fill out the form, everything's going to be fine. And they actually do stock transactions as that, because here's the thing. If I donate IBM stock, I can find out what IBM stock was on that date because I can go to the NYSE and, in the old days, you open up the newspaper, look for IBM and say, yeah, that's what it was. Nowadays, you just go to do a financial Yahoo search and you can find out what it was on that day. So it's gotten a lot easier because of technology. Of course, back in the 80s when they used to do this, it was a little bit more difficult because you'd have to hope to God you had a copy of that newspaper. But it was still published, so they could use it and it wouldn't be that much of an issue. The problem that you run into is when you're donating something that the fair market value is not readily determinable. So if I have like a sewing machine and I've had it for 15 years and I want to donate it to an organization that's going to help help third world countries, do sewing products so that they can, sewing type stuff so that they can, do business ventures. Actually, I know a friend of mine who's actually involved in something like that in Nepal. So that's kind of why it's probably fresh on my brain. He actually has it where he picks up old used sewing machines and he ships it back home to Nepal. And then his brother has a corporation that they've set up, a nonprofit corporation where they actually train people, men and women, to work in the textiles industry and sewing industry, so that they can actually do a lot of these things and get those valuable job skills. And that's actually very helpful because then they get jobs at the local factories, and then their quality of life goes up. So charitable deductions for under the accrual method. So if you have a corporation, a client that's going to be doing the donations and their accrual method, they can actually have their board meeting and they can actually do it to approve. It has to be done by the end of the year and then pay within 3.5 months. Why 3.5 months? Because that's when the tax return is due. It's due 3.5 months after the end of the year. So if, 2.5 months if the end of the year is June 30th. But for the most part, I mean, usually what will end up happening is the board of directors will do it. They'll contact the financial department will do it, and then they get that done. And if that happens, they can go ahead and they can take the deduction in the current year. Deduction is limited to 10% of taxable income. That's been that way for years. I mean, they don't want corporations coming out and saying, "Oh my God, we got $1 million of taxable income. I want to get rid of this. We'll just make $1 million donation to this organization, not pay taxes." So they do actually limit this. But it's taxable income before deducting for charitable contributions, obviously, capital loss carrybacks, and the DRD. So that's very important. If you do have any excess, you can carry, they say you can carry forward for 5 years. That actually prevents some corporations from going gangbuster like in 1 year and then because they've got the 5-year limit. So that's why actually what you'll notice with a lot of, especially very sophisticated corporations, they'll have a charitable contributions committee. And the whole job of the Charitable Contributions Committee is to meet, like, say for example, they set up a scholarship that they're going to do, and they do this through the foundation that they found. They'll actually physically meet with the individuals, make sure that they qualify for the scholarship, blah, 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 so on and so forth, before they actually go ahead and kick it out to them. And then they'll also have, in corporations, especially a lot of the big name corporations, they get requests for donations all the time. So the whole job of the committee is to actually meet and then decide whether they're going to help this organization or not in line with their mission statement. Usually the CEO, I don't know how involved the CEO normally gets involved, but some CEOs get really involved with this and say, look, this is my mission. This is my vision for the organization. I want you to donate to nonprofits that actually meet with this mission and vision that we have. A very common one that I would think that comes off my mind is Starbucks. Starbucks tends to do this. I've actually been to Starbucks headquarters where I met with one of their chief training officer. Actually, she and I we had coffee together. Imagine that, coffee at Starbucks. No, we had coffee in her office there, and it was a phenomenally great lady. In fact, I still keep up with her. She's no longer at Starbucks. She's actually at Wendy's last time I checked, doing good stuff for them. So that's actually really good. So this charitable contribution example, PCC donated a total of $700,000 to the American Red Cross. Taxable income for everything was $6,287,000. What is the charitable contribution they're allowed to deduct for this year and the carryover to next year? And this is how this is going to work out. Okay, so you do the math, you kind of figure this out. Yeah, so you got to add back in the NOL from the previous year, and then you kind of get to the end of this and figure that out. That's kind of the math. So the DRD, basically what they're trying to do here, so corporations already receive double taxation. So if I pay out dividends to my shareholders, I don't get a deduction on my corporation's tax return, and you got to pick it up as income on your tax return. It's one of the few areas of double taxation that actually exists in the tax code. Okay. Now, say for example, I'm a corporation and I have another owner of me that's another corporation. And then say that corporation is owned by another corporation. If I pay out a dividend, I could be, say if I pay out $100,000 and it goes all the way down. I have here where I pay taxes on it. The dividend, when it gets received by the new corporation, is paid out at $100,000, then another $100,000, and so on and so forth. You see how you can get triple, quadruple, quintuple of taxation layers. So they try to avoid this by offering the DRD. In the past, it was a little easier and a little bit more juicy. It used to be like 70, 80, and 100%. Now it's down to 50%, 65%, 80%. And these are the rules. I would know this cold before you go to the CPA exam. We may put a question on this. This is a question that I think we talk about a lot in tax classes. I don't see this as much of an issue, but it seems to be like one of the things that students tend to memorize, but then they go to the firms and then they don't do it. It's not just, and look, I'm not trying to make a criticism here. I just think, you need to know this for the exam. And if you're going to work in the corporate world, you probably need to know it, for all that stuff. And this is going to be a DRD example. I'll let you go ahead and read this while you look at my smiley face. And that's all I got to say about that. Okay, this has been a great class, corporate deductions and DRD. I want to say thank you very much for coming to class, and I hope to see you at the next video.